Hello everyone. Today here we have a question from 2018 paper 2 main exam, and this question requires you to prepare the income statement and the balance sheet. What we will do for today's session is to know how to prepare the income statement by going through the question in depth and also understand all the workings that are involved. So let's start with the question now. The following balances were extracted from the books of Somnial Pte. Limited on 30 June 2018. So here you can see we are given a list of balances within the trial balance for various accounts. And we are also given the additional information at the end of the financial year for adjusting purposes. The main requirement of the question is to prepare the income statement for the year ended 30 June 2018 and then also prepare the balance sheet at 30 June 2018. As we have mentioned earlier, for the purpose of today's session, we will prepare the income statement first. All right, so let's look into the workings, starting with the first additional information that we're given. At 30 June 2018, wages and salaries of $1,350 were accrued. All right, so what do we understand by that? Accrued wages and salaries of $1,350 refers to a current liability. What do we understand by the word accrued? This means that wages and salaries in expenses have been incurred, but we haven't paid our staff yet. We haven't paid our employees yet. We have used their labor, we have used their hard work to help us run the business, but we are still yet to pay them. Therefore, this is classified as a current liability, and as you know, all liabilities are to be reported within the balance sheet. Now, the total for wages and salaries expense that we have incurred for the financial year ending 30 June 2018 is the $86,950, which we are given within the trial balance, as you can see here. Wages and salaries of $86,950 plus an additional $1,350, which we have incurred, but we haven't paid yet. This is still part of the total expense. And altogether, the total wages and salaries expense comes out to be $88,300. Now, this entire amount for wages and salaries expense of $88,300 is to be reported within the income statement. All right. Now, let's have a quick recap. First of all, we have accrued wages and salaries of $1,350. When we say it's accrued, it means that we have taken the benefits, we have used the hard work of our staff or our employees, but we still haven't paid them yet. And therefore, this is money that we owe to our staff and therefore classified as a current liability and is to be reported in the balance sheet. Then you've got the total for wages and salaries expense. The total for wages and salaries expense is $86,950, which we have taken from the trial balance, plus an additional $1,350, which we have incurred, but we still haven't paid yet, but altogether it increases the total wages and salaries expense for the business. So altogether, the total wages and salaries expense is $88,300, and this is to be reported in the income statement. All right. Now, the next information that we have for point number 1 is that rent of $6,000 were prepaid. Now, when we say we have got prepaid rent of $6,000, this is referring to rent payment that we have made in advance. Let's say currently we are preparing the accounts or the financial statements for the year ending 30 June 2018. At 30 June 2018, if we have rent of $6,000 which we have prepaid, this rent refers to the next financial year starting 1 July 2018. So at 30 June 2018, this rent refers to payment made in advance, and there are economic benefits which are attached to this prepayment of rent, and we still haven't used these benefits yet. Therefore, we can classify this as a current asset, and this is to be reported in the balance sheet as prepaid rent of $6,000. Now, what about the rent expense that we include in the income statement? Now, the total for rent that we are given in the trial balance is $31,000. Now, this $31,000 also includes the $6,000 of prepayment that we have done. Now, the total rent expense needs to exclude this rent that has been prepaid because the prepaid rent doesn't relate to the financial year ending 30 June 2018. the prepaid rent relates to a new different financial year, right? So when we are preparing the income statement for the year ending 30 June 2018, the total rent expense will be $31,000, which is the amount that we have taken from the trial balance, minus the $6,000 in prepayment, because this is not an expense yet, it's a current asset. And altogether, the rent expense is $25,000, which is what we're reporting in the income statement. All right. Now, let's look into point number 2. Equipment is to be depreciated at 10% per annum using the straight line method. When you want to find depreciation using the straight line method, it's pretty straightforward. You use the given percentage of 10 and multiply it with the original cost. Always remember, when you're finding the depreciation using the straight line method, you apply the given percentage and multiply it with the original cost. So 10% is multiplied with $275,000. So $275,000 is the original cost that we have taken from the first line in the trial balance. Okay, so altogether, the total depreciation of equipment is $27,500. This is an expense which we report in the income statement. And when you're preparing the balance sheet, the non-current assets section, you have to also show the total for accumulated depreciation. Accumulated depreciation simply means the total depreciation for the asset that we have so far, which is $55,000 being the old total that we have been provided here in the trial balance, plus an additional $27,500, which we have just calculated. And altogether, the total accumulated depreciation of equipment is $82,500, and this is to be reported in the balance sheet when we prepare the non-current assets section. All right. Now let's look into point number 3. Point number 3, motor vehicles are to be depreciated at 25% per annum using the reducing balance method. Now, how do we find the depreciation using the reducing balance method? We first calculate the net book value. How do we calculate the net book value? The net book value is simply the difference between the original cost and the accumulated depreciation. The original cost is $48,000 and the accumulated depreciation is $21,000. So let me just show you where I got these numbers from. So here you can see the motor vehicles at cost of $48,000 and the accumulated depreciation of motor vehicles of $21,000. So this gives us a net book value of $27,000. All right. Now, how do we find the depreciation using the reducing balance method? We apply the given percentage, which is 25, given in the question, and multiply it with the net book value of $27,000. So this gives us a depreciation of $6,750, and this is an expense that we report in the income statement for depreciation of motor vehicles. Now, what about the total that we report in the balance sheet? In the balance sheet, we report the total for accumulated depreciation. And the total for accumulated depreciation is the depreciation that we have calculated for the current financial year ending 30 June 2018 of $6,750 plus the $21,000, which we had the previous accumulated total, which we have taken from the trial balance. So altogether, the total accumulated depreciation is $27,750, which is what we report in the balance sheet. All right, so let's look into point number 4. It was decided that the allowance for impairment of trade receivables on 30 June 2018 should be $650. Now, in the previous financial year, we had an allowance of $850, and in the current financial year, the allowance is $650. So we can see that there is a reduction from $850 to $650, and the amount of reduction is $850 minus $650, which is $200. Now, when there is a reduction in allowance for impairment of trade receivables, it's a good thing for the business because now we expect more of the trade receivables to not go bad or to not be impaired. We expect to collect more cash from our trade receivables or credit customers. So we always classify this as an expense, but this time, because the amount has dropped from $850 to $650 and the reduction is $200, this is a good thing for the business. And when you prepare the income statement, you need to show this as a negative figure under the total expenses that we report when we prepare the income statement. All right, so just to simplify this, there's a reduction in allowance for impairment of trade receivables of $200. And how did we get this $200? For the year ending 30 June 2018, it's $650, and for the previous year, it was $850. When there's a reduction in allowance for impairment of trade receivables, it's a good thing for the business because now we expect to collect more of the cash from our credit customers. All right. And when you prepare the expenses section in the income statement, you are to show this number as a negative because there's a reduction and this is a good thing for the business. Okay. All right. Let's go to point number 5 and 6. A repayment of $5,000 on the 10% bank loan is to be made during the year ended 30 June 2019. All right, so we're preparing the income statement for the year ended 30 June 2018. And we know in the year ending 30 June 2019, we will repay $5,000 for the bank loan that we have taken. All right, now this bank loan is something you will see within the trial balance. 10% bank loan repayable June 2025, and that amount was $35,000. We expect to repay $5,000 out of this $35,000 in the next financial year ending 30 June 2019. Okay? Now, this is what we classify as a current liability. The reason this is a current liability is because, first of all, this is the amount that we owe to the bank. And why is this current? Because we expect to repay this loan within the next 12 months. Given that we're preparing the income statement at 30 June 2018, and the next 12 months from 30 June 2018 would be 30 June 2019, this repayment of $5,000 clearly falls within the definition of a current liability, which is simply referring to obligations that are due for repayment in the next 12 months. All right? So when you prepare the balance sheet, in the balance sheet, under the current liabilities section, you need to show short-term loan repayment of $5,000. Okay? Now, there is an interest rate associated with this bank loan, which is 10%. All right? Now, this 10% is an annualized rate. We like to say this as 10% per annum. So if I want to calculate the interest expense, which is the cost of financing, remember, no bank loan is obviously free. The bank will obviously take something from you by giving you this loan, right? And that what you are supposed to pay the bank is the interest. So let's calculate the interest expense on an annual basis. The interest expense per annum is simply 10% multiplied with the original loan amount of $35,000, and the original loan amount is what we have taken from the balance sheet. So the interest expense on an annualized basis is $3,500 based on our calculations, and this is the total for interest expense that we are to be reporting in the income statement. Now, we know that the interest paid in cash during the year is $2,625. Where did I get this information from? As you can see, it clearly mentions here interest paid on 10% bank loan of $2,625. So if the interest paid is $2,625 and the total interest expense for the financial year is $3,500, this means that we have accrued interest or interest that we still haven't paid yet, or the interest that we owe to the bank people. All right. And that amount that we owe, or that amount which is accrued, is the difference between $3,500 and $2,625, which is $875. And this accrued interest, the amount that we owe, or the amount that we still haven't paid yet, is classified as a current liability and is to be reported within the balance sheet. All right? Okay. What's the last additional information that we've got? A dividend. A dividend of 5 cents per share had been declared and will be paid on 31 July 2018. So remember that we are preparing the financial statements for the year ended 30 June 2018, given that this dividend is to be paid on 31 July 2018. All right? So let's first calculate the total dividends. We know it's $0.05 per share in dividends that we are paying. Now, what do we understand by dividends? Dividends are share of profits that are given to the owners or the shareholders. Now, we are working with a business which is a private entity, as you can see, PTE Limited. So this is a private company, and within this company, we can have many owners, and each of these owners who have invested in the company deserves some dividends, and that dividend is $0.05 per share or 5 cents per share. Now, how many shares have we got in total? It's given in the trial balance, which you can see issued share capital 300,000 ordinary shares. So altogether, we have got 300,000 shares. And if the dividend is 5 cents per share, then we just simply multiply 300,000 with 0.05, which gives us $15,000 as the total dividends. Now, if you read the question very carefully, you will see that they have mentioned that the dividend had been declared. So declared means it hasn't been paid yet, okay? It will be paid on 31 July 2018, which is in the next financial year or the next month. Because this hasn't been paid yet, remember that we're preparing the financial statements for the year ended 30 June 2018, and this dividend will be paid on 31 July 2018. So at 30 June 2018, when you are preparing the income statement and the balance sheet, this dividend is to be reported as dividend payable because we still haven't paid for this dividend in cash, right? So the dividend payable is $15,000, and this is a current liability, and all liabilities are reported in the balance sheet, okay? All right, so now let's just quickly prepare our income statement. So how do we prepare the income statement? First of all, we write that we're preparing the income statement for Somnil PTE Limited. So Somnil PTE Limited income statement for the financial year ending 30 June 2018. So I'm just going to write this here. And we can prepare this income statement in 3 columns, all right? Okay, so everything here is reported in dollars, as we understand. Now, what's the first item that we can include? It's always the sales. Now, the sales revenue is given to us as 379,150. Okay, 379,150. Always remember to subtract the sales returns from the sales and to get the net sales. So sales revenue is 379,150 minus the sales returns, which is 24,550. So when you subtract the total for sales returns from sales revenue, we arrive at net sales revenue. Okay, so I'm just going to use my calculator to find the answer. So 379,150 minus 24,550. So that is 354,600. So that's the net sales revenue that we have got. Then we subtract the cost of sales. The cost of sales, is it given to us directly in this question? Yes, which is 149,900. So from the net sales revenue, we subtract the cost of sales of 149,900. So once you subtract the cost of sales from the net sales revenue, we get the gross profit. And the gross profit is therefore the difference between the net sales revenue and the cost of sales, which is 204,700. Okay? We do not have any discount received or any other income that we could add to gross profit. So therefore, we are going to jump straight to expenses. All right. Now for the expenses, we want to start by looking into the trial balance. So first of all, we have got equipment and motor vehicles costs, which both fall under the definition of non-current assets. Then we have got inventory, which is a current asset. We have already used sales revenue and sales returns. We've also used cost of sales. We know that the 10% bank loan in itself is a non-current liability, but we do know there's an interest expense. Now, the interest expense, if I was to scroll back up, we know that we had calculated the interest expense on an annual basis to be 3,500, right? So this interest expense is the first item under the expense section that we're going to include. So interest expense is 3,500. Next, if we check the trial balance, we've got trade receivables, which is a current asset, trade payables, which is a current liability. We've got allowance for impairment of trade receivables. Now, if you recall, we had this discussion regarding the allowance for impairment of trade receivables. And based on our calculations, we understand that we have a reduction in the allowance in this year, and that is $200. When there's a reduction in allowance for impairment of trade receivables, it's a good thing for the business. And therefore, when you're preparing the expense section, you need to show this reduction as a negative amount because this is a good thing. It's not a cost, it's actually a saving cost for you because now you expect to collect more of the money from your credit customers compared to the past. So what we're going to do here is we will write reduction in impairment loss of trade receivables. And we are going to show this as a negative number of 200. Remember, all expenses by default are a cost, but this is not a cost, but you are reporting this within the expenses section. And we are showing the number as a negative number or within brackets because to only imply that this is a good thing. All right? Okay. Next, we have got the cash at bank of 6,300, and they're saying it's credit, which means this is a bank overdraft. Okay, and this is a current liability, nothing to do in this income statement. Then we've got the rent expense and the wages and salaries. We've already done the workings for this too, the rent expense and the wages and salaries. So in the first additional information, we had done the workings for this too. So let's look into the first point that we have done. So we know that rent expense is $25,000 after removing the prepaid rent of $6,000, and the wages and salaries is $88,300 after adding the accrued wages of $1,350. All right, so let's just write these two numbers here. So wages and salaries are $88,300, and then we have got rent expense of $25,000. Then we have got the general expenses, which is the last expense that we need to report. We do not have any adjustments here, and that is $27,800. All right. Actually, we forgot the depreciation. So it's not really the last expense. We've got depreciation of equipment and depreciation for motor vehicles. So let's just include those two as well. Some depreciation of equipment, as we have calculated, was in point number 2, and that was 27,500. All right. So depreciation of equipment is 27,500. And then we have got depreciation of motor vehicles. So let's scroll back up. So depreciation of motor vehicles was 6,750. That's it. All the expenses have been listed. Now let's find the total by adding all these amounts that we have been given. Make sure to show the 200 as a negative, as you already know that this refers to a reduction in impairment loss of trade receivables, which is a good thing. All right. So the total expenses that we found after we have added everything is 178,650. So once this amount is subtracted from the gross profit of 204,700, then we arrive at a net profit. And the net profit, or the profit for the year in this case, is $26,050. Okay? All right.